This is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Clint Korver of Ulu Ventures. Clint, thank you for joining us.
Pleasure to be here, Hall. Thanks for the invite.
Well, Clint, how did you get into venture capital?
Well, I've been in the venture capital startup world for about 25 years now, ever since I graduated from Stanford and started my own company. I got into venture about 10 years ago, mostly because my wife and partner, Miriam Rivera, was an early employee at Google, and we had a nice exit there, and so we basically got into it through the angel investing side. And so basically invested our own capital. It was full time. So we would actually take board seats and price rounds, and we looked like a venture capitalist from the entrepreneur's perspective, even though we're just investing our own capital. And now we've just finished raising our first institutional fund.
So tell us more about that Ulu Ventures. What are they all about?
Yeah, so we're a seed stage enterprise IT focused venture fund here in Silicon Valley. And we're investing at the earliest stages, so pre-seed, seed, post-seed. Occasionally, we'll even make a Series A investment. Tend to focus on deep analytics. So enterprise IT companies where analytics is a big piece of it. FinTech, EdTech, legal tech. These are areas of specialty, but broadly speaking, enterprise IT.
Well, you also use data analytics to make investment decisions. Can you talk a little bit about that process?
Yeah, so we would call this one of the ways that we're different from most venture capital funds. We use it, call it industrial grade analytics, if you will, for how we make decisions. Now, it comes in a couple of flavors. So up front when we're just meeting companies, it's still very much a qualitative process. So we're looking for big markets, compelling teams, fit with our strategy, and that's what we use to filter. But when we find a company that we're very excited about, we literally get in a room with them, and the step one is we want to create a map of their market opportunity. So this would be their business model, target markets, adjacent markets, competition, how this stuff changes over time, and literally get a picture of how all this stuff comes together. And then we quantify everything. Now, we fully appreciate that anytime you put a number on something in this startup world, it's guaranteed to be wrong. So when we quantify things, we always quantify it with ranges. So if an entrepreneur says this is $1 billion market opportunity, our question is, well, by that, do you mean somewhere between 900 million and 1.1 billion? Or is this one of those $0 to $10 billion ranges? Because all our challenge in our diligence process is understanding the risks, and the risks show up in the ranges. So our first step is to get the ranges, and then the next step actually is sensitivity analysis. So which of these ranges matter? If there's 50 factors, there's only 4 or 5 that matter. And the challenge is figuring out which 4 or 5 those are. And we've got a set of templates and benchmark data that we also apply along with the market map to identify the key drivers of risk and value. And that whole process ends up taking us a couple of days. But by the end of it, we've got a very focused set of next steps now in the diligence process. And that now can look like calling customers and reference checks and competitive analysis and all the standard sort of things. But at the end of the day, we're looking for what we call a 10x probability weighted multiple on invested capital. So that all that activity boils down into that one number.
Well, there's many different kinds of data analytics that come into the funding process. This is just one of them. What are the others?
Yeah, so I guess high level, there's probably like 7 major categories, if you will. So there's the total addressable market. There's a market share question, which is all about differentiation and competition and these sorts of things. And that you can think of those two things as driving into revenue. But now you've got, okay, is anybody going to value that? So there's a whole exit environment. It's like, what's the multiples in the public markets or who might acquire us? Then there's the dilution, how much additional capital is going to be needed with this company as they go forward and so forth. And then you've got the whole earnings piece and whatnot. So there's actually not a lot of pieces, but it's enough pieces that it's very difficult to keep this all in your head. So from our point of view, it's really important to put this down on paper, be very explicit about how our assessments show up in the form of numbers and probabilities. Because the challenge here is if you can't keep it in your head, then you're very susceptible to cognitive bias.
So it's a data collection challenge, it's a data analytic challenge, and then there's a synthesis challenge at the end with all these different data sets, it sounds like. How do you manage that process?
Well, so it's taken us 10 years to develop this process. And it's actually based on and by the way, and we didn't invent this ourselves. So we took a set of best practices that are right now, if you go to pharma R&D or oil and gas exploration, this decision analysis, that's the basis for what we do, is best practice in both these industries. And what's interesting in my mind is that both these industries and venture capital have effectively the same dynamics in their business model, which is the vast majority of the things you do are going to, at the end of the day, be zeros or you're going to lose money on. And every once in a while, you'll get a blockbuster or a home run or an outlier success. And essentially, all the profit in the industry comes from those very small number of outlier successes. So it turns out, like I said, it's not really used, frankly, other than Ulu at all, as far as I know, in the venture world. But in the pharma and oil and gas world, it's very commonly used, this process for analyzing decisions under uncertainty.
It sounds like you have a tremendous amount of data, accurate data about it. And do you find that's readily available in the venture world? These are all known numbers, such as the exits and the risk probabilities. All of this can be found?
Well, so that's actually one of the, I think, the myths, if you will, that you need data in order to run this kind of process. And I'd actually argue that the more uncertainty and the smaller amount of data there is, the more value you get out of this process. The problem is, so if you're in a world with lots of data, now your cognitive biases, you've got a feedback loop that helps you learn. But when you're in an industry like venture, where the typical venture capitalist GP at a firm is making 1 or 2 investments a year and it's taking 8 or 9 years to figure out if that company's a success or not, that's frankly a terrible learning environment. And so what happens is you have these biases that have no way to be updated. And oh, by the way, there's a little bit of ego in this industry too, which is also not so great on the learning side. So it's the fact that it's actually sparse data and there's a lot of judgment and uncertainty that comes into play that makes this process valuable.
So it sounds like it's quality over quantity, and as far as the amount of data that you bring into it, you need less data, but the right data to make these decisions. Is that right?
Yeah, and a lot of it is just frankly appreciating the risk. So here are some statistics for you. Cambridge Associates tracks the top 100 deals in venture every year, and those deals represent essentially all the profit in the industry. This is out of 4,000 venture deals that are done. In other words, if a venture investment is made, it's got a 2.5% chance of turning into something interesting. Now, if you go to the very top tier firms, the Sequoias and Greylocks and Benchmarks of the world, and Horsley Bridge has some data. Horsley Bridge is one of the top fund of funds out there, and they've been investors in all these top venture funds for decades. And they report that 4.5% of the capital from these top tier funds generates 60% of all their profits. So in other words, the top tier VCs, round numbers, bat 5%. So they're twice as good as average. That's a scary number. In other words, you can do everything right. So you can source like Sequoia and you can diligence like Greylock and help companies out like Benchmark. And at the end of the day, you're batting 5%.
Well, it's a hit business for sure. And it sounds like data analytics is one path to getting to the big hit. But it doesn't sound like it's very easy either. It sounds like it's quite a process.
Well, I think the sort of appreciating how risky this industry is. Now the question is, well, what do you do about it? And actually, portfolio construction is one of the core ways that you manage risk when you're a venture capitalist, from my point of view. I mean, there's only so much you can do on the sourcing and the diligence and picking entrepreneurs. And really, it's like the entrepreneurs that are creating companies that are going to be, the next Googles and Facebooks and Ubers of the world. At the time they're raising those really early rounds, it's not at all clear that they're going to be a success because they're trying to do something different that doesn't fit any of the standard patterns that are out there. So, basically, these are really hard to pick. Now the question is, okay, how do you manage your business as a venture capitalist? And to cut right to the chase, our notion is, if we bat 5%, so let's give ourselves a little benefit of the doubt here, and let's say we're in the same league with these top tier VCs, we think we need to have at least 50 investments in our portfolio. And even at 50 investments, we still only have a 90% chance of being in one of these outliers. So this is just probability math to get there.
So in portfolio management, you have to apply these number of cases to it as well. And if you're in 50 deals, you have a 90% chance. That sounds like a pretty good chance, but it's not. I guess in venture, it's never certain. It's never 100%.
Well, yeah, I mean, and by the way, we have kind of funny conversations with our LPs, who are the investors in our fund, and we literally show them our analysis, and we say, okay, if we're batting 5% with each investment, and we stack 50 of these together, here's how we come up with 90%. But what that means, there's a 10% chance here where we can do everything right, and at the end of the day, we have no outliers in our fund, and it's frankly pretty mediocre returns for everybody. And oh, by the way, if we could bump that up to 70, now we're more like 95, 96% chance. So that's even more comforting. By the way, bumping up your portfolio size, the only way you do that and increase your probabilities, you have to maintain your quality standard. So we say, so we're going to increase our portfolio size, for example, but only if we can find companies that pass our 10x probability weighted multiple benchmark. So in building the portfolio, you have to maintain the quality of the deals coming in, and then you also have to maintain the actual portfolio management side of it. Do you get any benefit from diversifying across sectors or diversifying across geographies? What kind of impact does that have on your portfolio theory? Yeah, so theoretically, diversifying across these different factors would be good for the portfolio, but that needs to be you have to kind of overlay that with how do we think we're going to be able to make money? Or how do we think we're going to be able to compete in this market? And another element of Ulu Ventures is we tend to do a lot of stuff at Stanford. So I used to teach there. My partner was on the Board of Trustees. We have like 6 degrees from Stanford between the two. So that's really our community. And when we looked at our portfolio from Fund 1, our companies out of Stanford really outperformed our companies from anywhere else. And I think part of that was just that we have like such a strong network in that community that we're able to get into the best deals and the best entrepreneurs are able to find us. So in Fund 2, we're doubling down on Stanford. And by the way, so if Stanford turns out to be a lousy place to find entrepreneurs, we're going to be in some trouble here in Fund 2. But that's kind of some of the, if you will, the trade-off bets. So we're not really diversifying across other geographies. We're really doubling down where we think we can be successful. But then on the companies themselves, we do have diversification across industry sectors, if you will. So we're enterprise, but we have a lot of fintech investments and investments in manufacturing. And so we have some diversification there. Well, it seems like if you spread it across, not all the great deals are going to be in one sector, and one sector could go down. They come in and out of favor all the time, that we'd have to have some variation to different levels to get the right portfolio mix. Are there any other aspects to the portfolio theory that needs to be brought up? Yeah, and this is probably, so I'd say out of the venture folks that we know, I'd say 10 to 20% subscribe to this large portfolio theory, and the vast majority, a much more concentrated portfolio. The second element is more controversial. So we don't believe in doubling down on our winners. And by the way, almost everybody in venture, at least that we've run across, they say, you can make a bunch of investments up front, and then your winners emerge, and you have this big reserve pool so you can double down on the winners. And boy, that's where you're going to make most of your money. And when we run the numbers, it's exactly opposite of that. So here's the easy way to think about it. As soon as you hear the word winner, we hear overpriced. That's a good point. The first check is always the biggest return. The second check is always the smallest return, for sure. Let me just give you a sense of like how extreme it is. So there was a company, App Dynamics, that got bought for about $3 billion. It was about ready to go public about a year ago. It got bought for like $3 billion. And it was reported in the press that Greylock made 100 times their money on this investment. And then they came back the next, press being venture capital journal, they came back the next day and they said, oh, sorry, we made a mistake. Greylock made 100 times their money on that first $3 million investment. So they put $3 million in, they made $300 million on that first investment. They later put another $20 million in and got another $100 million out. So by the way, it's pretty good. So they got, 5X on that second tranche, but they got 100X on the first tranche. In other words, that first $3 million swamped any of the benefits of any of the follow-on rounds. So our whole model is we want to be in those first rounds that have that 100X potential. And just to give you kind of a sense of scale here, and this is also stuff that we share with our LPs, by the way, that gives them a lot of heartburn because we're different than a lot of folks when we say this. We want to put all of our capital, well, first of all of our capital, we want to have that 10x probability weighted multiple. That's the criteria. So when we're investing a check or investing a dollar, we compare it to every other place that dollar could be. Follow-on rounds, new companies, existing companies. And what we've found, and these are, your mileage can vary based on your skills and sourcing and all that sort of stuff. What we found for us is that by putting all of that capital up front, as opposed to doing a traditional reserve fund of 2 to 3 to every dollar we put up front, we save another $1 to $3 in a reserve fund. By putting it all up front, we double the expected multiple on our fund, and we also double the expected ownership in our best companies.
Well, that's quite a return and quite a feat when that happens. So looking forward to seeing the results on Fund 2. How long have you been into Fund 2 so far?
So we've been investing out of Fund 2 now for about a year and a half. We're 30 companies in, and I think it'll be about a 70 company fund by the time we're done. So we're a little less than halfway through it.
Okay. So we're going to get another year and a half. We'll have probably 60 or so companies funded. And so from there, we can start to see who's pulling ahead and what that might look like for the return. So sounds like a great investment thesis, and looking forward to seeing the results that come out of it. In the last couple of minutes that we have here, what have we not covered that we should have?
Well, I think we've covered a lot. Oh, here's kind of an interesting data point in terms of like the industry. And by the way, there's a theme here, right, on terms of data. It's like there's a lot of assertions running around this industry. And my favorite question is, on what are you basing that? So by the way, here's the question to ask yourself. So if you're a VC and you're saying, this reserve strategy that Clint's talking about just seems dumb. So here's the question. What's the return on your reserves? So not the return on your fund. You can think of what's the return on those first checks versus what's the return on the later checks. And the VC firms that I've talked to that have actually done this analysis, it's a very surprising number. Okay, so here's the data I was thinking about. I just want to talk about. So the company Burgiss. So Burgiss is essentially an accounting software system for private equity and venture and so forth. And they've been around now for about 30 or 40 years. And they've rolled up essentially all of this data. And by the way, so the nice thing about the Burgiss data, there's no selection bias. So it's not like people are voluntarily giving in the good data and then withholding the bad data. So this is anybody using their accounting system. And it comprises, there's about 400 funds and over this 40 years. The mean return from early stage venture, 22% over those 40 years. Best performing asset class by far in the US. The median return is 5.6%. It's the worst performing asset class in the US. So now here's the thing. It's like, so early stage venture is one of the only asset classes in the US where the mean and the median are dramatically different. So median is the 50 percentile point. So 50% of the funds that perform better than this, 50% have performed worse than this. The mean is the probability weighted average. And the thing about the mean is every once in a while you have these funds that invest in a Google or a Facebook or a WhatsApp or so forth, and they just have these outrageous kind of returns, and that pulls the industry, the probability weighted average in the industry dramatically up. When you go to late stage VC, the mean is 12%, the median is 11%, essentially the same thing. So this difference between the mean and the median, the implication for me is if you do one investment in your portfolio, you basically get the median, because that's the most likely thing to get. If you have a very large portfolio, you're more likely to get the mean. So the way to get closer to the mean is to have a larger portfolio. And now in terms of follow-ons, if I'm doing the average early stage investment, got a big portfolio, I'm getting 22% of my money. If I do the average late stage venture investment, I'm getting 12% of my money. So that would also argue in my mind to put as much money up front as possible. So I went through before a bottoms up approach. This is, if you will, looking tops down at the industry. I think you come up with, from my point of view, I come up with the same conclusions.
Well, without doing the follow-ons, it sounds like you have something of an index approach where you give the same amount to as many companies as meet your investment thesis. And at some point, you'll have the best valuation because you got in on the first round. And then the outliers is what's going to pull up the fund in that particular case. But maybe index is not the right way to say that.
So I'm happy to have an index of the top investments. So any investment that passes our probability weighted multiple criteria, I want to be in. So once it gets past that, now I'm not making distinctions. The problem with it, and there are some index funds, index-ish funds in venture, and the general problem there is adverse selection. It's easy to get in the deals that are lousy, and it's hard to get in the deals that are good. So if you're indexing, you're not putting a lot of effort to getting into those good deals, and you end up with a lot of bad deals. That's kind of the general critique, which I think has some validity. But we're working our butts off to get into the best deals, and then we want to get into a lot of them.
But do you make the same investment amount on every deal, or do you adjust the amount based on the data?
So it's 80% of the time, we're writing a $500,000 first check. That's our average initial check into a company. And then 20% of the time, we find something that blows our hair back, and maybe we write $1 million check into those.
So it's pretty much the same across the board with a few exceptions then.
Yeah. Yep.
Well, that's great. Well, I appreciate you taking time. What's the best way for people to get back in touch with you?
So you can go to uluventures.com. You'll see our website, and you'll see some of this information and how we like to make decisions. And you'll also see kind of a little bit more background of who we are and how to get a hold of us.
Well, great. Well, we'll put that in the show notes so people can get back in touch with you, because I'm sure you'll have lots of questions about your process and your program there. Appreciate your taking time to join us today, and love to have you come back in a few months and give us an update about how it's progressing forward.
Thanks, Hal. It's a pleasure being on your show.
Thanks so much.